What do you get when you spend tens of billions of dollars investing in an entirely new enterprise for your Fortune 500 company and then roughly 7 years later have little to nothing to show for it? Well, you get Disney Plus. And isn't it funny that some of the boys on Wall Street are finally coming around to a financial position that I've held on this channel for nearly 5 years? Asking the question, at least from one such Wall Street analyst, of whether or not Disney should exit the streaming business. Well, this should be fun. Renegade Online. Yeah, isn't it amazing? It's absolutely amazing out there that we're finally seeing some resolve on Wall Street. Maybe it's because now Bob Iger isn't the head honcho of Disney anymore. Maybe it's because they feel like Josh D'Amaro is at least more sensible, or perhaps even if only more pliant when it comes to the Wall Street gurus out there asking the tough questions. We know Bob Iger has largely been softballed over the years, as many CEOs do. He's not alone, but now we're finally getting some real solid questions. And some of these questions are the same ones that we've been asking for nearly 5 years. Let's get to the article from The Hollywood Reporter. Should Disney exit the streaming business? Stephen Cahall from Wells Fargo argues in a new research note to Wall Street or Wells Fargo investors that focusing on intellectual property and experiences could raise Disney's stock price by 40%.
Where's my money?
So let me stop right there real quick and acknowledge the reality of what is the situation with Disney's stock price. We have looked at this for quite a while. And yes, a lot of people in the same entertainment and television media space have suffered a lot of the same economic and financial doldrums in terms of stock price over these last several years, especially since COVID. But Disney's kind of in a special situation. It's the only member of that segment, that sector on Wall Street that enjoys being part of the vaunted Dow Jones 30. Nobody else is on there. Warner Brothers isn't on there. Netflix isn't on there. Paramount isn't on there, although maybe one day they will be after a merger. But Disney is on there largely because they encompass such a wide swath of the entertainment industry, including the biggest name when it comes to theme park and hotels out there, which vaunts them into that upper echelon. Let's take a look at the history briefly here of Disney stock price. Currently, you can see at the top of the screen that the Walt Disney Company stock price closed on Monday, July 13th at right around $96 per share. And if you look at where I have the crosshatch lined up on this chart, right at 10 years ago, July 11th of 2016, you can look up there the opening of $99.80 with a close of $99.80.
Hold up. Wait a minute.
Yeah, that's right. If you've held Disney stock for the last 10 years, you have lost money, both on an adjusted and an unadjusted basis. It's actually a couple of dollars lower today than it was 10 years ago. And that's throwing out inflation. And that's throwing out the 800-pound gorilla in the room, of course, which is economic opportunity cost.
Something ain't right.
From the same exact point 10 years ago on the S&P 500, the biggest benchmark that there is in the market for large cap stocks, of course, of which the Walt Disney Company is a part of, back on July 11, 2016, the S&P index was floating at 2,073. Today, they're at 7,500. That's a return of well over 300% while the Walt Disney Company has lost money. So now you're starting to get a feel for where Stephen Cahall of Wells Fargo is coming from. That being said, let's go back to the details of this piece from THR. The Walt Disney Company, despite being the undisputed leader among legacy entertainment companies, especially where everyone else is seemingly a buyer or a seller, they have been dealing with a stock price that has remained stubbornly flat over the last 5 years. Now, of course, he's taking into account a rather momentary spike that ran the Walt Disney stock price up to nearly $200 a share in the post-COVID exuberance of the streaming wars, for which Disney did not turn out to be a hot player as everybody thought they were. Netflix certainly enjoyed growth that overall sustained relatively well, even though it recently has rolled back from its highs. But Netflix is still far outpacing Disney in this. There's not a close second competitor in that space. But back to the article, that is despite Disney's status in the streaming wars seemingly secured, says THR. Paramount Plus, HBO Max, Peacock, and the rest are fighting for a piece, even as most observers say that Netflix and Disney are the only subscription players with the scale to compete already. But the problem therein lies is this idea of scale. And the scale that THR is referring to ultimately is subscribers. And that is a concept that Wall Street finally abandoned in the last couple of years because they realized that subscribers are not the end-all, be-all measure of fiscal success when it comes to streaming services. It's overall profitability, just like any other company out there. And upon finally realizing that even if you have 150 million subscribers, if you're still losing roughly $1 billion a quarter, your streaming service isn't worth a pile of donkey poo. One Wall Street analyst, however, says THR, Wells Fargo's Stephen Cahall, is asking a provocative question in a research note released Sunday to investors, I might add. What if the key to unlocking the Walt Disney Company's stock price is exiting the streaming business? Who's been saying this for a few years?
No. He's got a point.
Cahall of Wells Fargo suggests that if Disney returned to, quote, its old business model of producing versus distributing, closed quote, it could add 40% to the company's share price and tighten management's focus on creating and managing IPs as well as its lucrative experiences business. Oh, yeah, that sounds exactly like something I've said for 5 years. I really have to. Stephen Cahall of Wells Fargo. Are you part of the Renegade Nation? Have you been watching Valiant Renegade for years? Because damn, you sound like one of my guys. Yeah, that's kind of the key component. The Walt Disney Company has become, in the last 10 years, first and foremost, a theme park and experiences type company. They sell toys, they sell hotel rooms, they sell golf packages, they sell cruise ships, everything under the sun. That is the biggest revenue and operating income driver of the Walt Disney Company. The next closest second, frankly, is live sports and ESPN. And in case you've forgotten, there was quite a bit of pressure from a number of Wall Street aficionados out there in the last few years for Disney to investigate, if not outright consider or do, an actual spinoff of ESPN. And if you thought that idea was crazy, or you still think it's crazy, just go give Brian Roberts at Comcast Universal right now a phone call and ask him if he thinks it's crazy. Because that's pretty much exactly what Universal is doing right now. Separating different areas of the company from one another, spinning them off, leaving Comcast to itself to run the broadband, internet, and cell phone side of things, while leaving NBC Universal as its own completely separate publicly traded entity to focus on growing theme parks and the film and television studios. The Wells Fargo analyst was saying that if Sony is getting $1 billion annually from Netflix for its Pay One movie output deal, Disney could be in line for nearly $4 billion a year. When Pay Two and Disney's unmatched library is factored in, licensing revenues could hit $15 billion. Now, what has been one of the biggest and most obvious declining pieces of Disney's financial cash flows of the last several years? It is indeed content sales and licensing. Go back and take a look at what things looked like prior to 2019 when Disney Plus launched and how they have tracked since then. And then go look at some of their competitors out there that are more open with their licensing architecture, namely things like Universal Studios, that has, in my opinion, the best model out there in the market, where Peacock has become a relatively strong competitor in the streaming market space, although Universal is not so stupid as to consume all of its own product in its entirety and in perpetuity, meaning that the first 4 months, their new releases like Minions and Monsters right now will wind up on Peacock, but then spend the next 10 months of the pay one window over at Netflix for a big fat paycheck. Sony doesn't even have a streaming service. They just figured, we're not going to play in this game because it's stupid. It's too risky and too high cost. We'd rather just take $1 million cash flow, a paycheck from Netflix, and call it a day. What Stephen K. Hall from Wells Fargo here is referencing is exactly this going on at the Walt Disney Company. The in perpetuity consumption of its own products time and time again, not only in just the pay one window, but in the pay two window, the pay three, and so on and so forth. There's no licensing outside of Disney. So all of the cash flows that you see from content sales and licensing are simply consumed from other areas of the Disney accounting books. It doesn't work in the long run. And when you have a company like Walt Disney with its own proprietary streaming service that boasts nearly 150 million subscribers between Disney Plus and, of course, Hulu now that has been combined into it, you have to ask yourself, why is a streaming service at that scale struggling like it is when Netflix at the same scale looked far better? Now, I'm going to push back a little bit on this idea of licensing everything out from Disney down the road, because I think this is absolutely something that Josh D'Amaro, once he firmly has the reins, January of next year, and Bob Iger is allegedly completely gone, really needs to investigate. And that is that the pay one window should be licensed out, and then let the pay two and beyond windows come back to Disney Plus if they really want to maintain the streaming service. There's even rumors right now that there is a Disney Fast service or a free advertising streaming demand service that they would put out there that you don't have to have any subscription fee to get into. It's purely ad-based. And this is something that most companies have done with things like Tubi over there at Fox, or look at what Warner Brothers has with their Fast system, and many others are going to it. There is an entire massive amount of old dead library content out there that really doesn't generate anything for a paid or AVOD streaming service right now, but could actually have some benefit on a completely free system that is a free app that anybody could download onto their Roku, to their Amazon Fire Stick, or their Apple TV. Disney needs to consider this strongly, because everybody else seems to be figuring out that simply consuming all of your own content to your proprietary streaming service just doesn't frickin' work. So let's say Disney would strike a deal with something like Apple, or even a Netflix in this case, and receive billions of dollars a year to have the pay one window for all of their theatrical releases. Yes, up to and including things like Avengers Doomsday later this year. Or how about recent duds like Moana in the theater right now? Or even Snow White from a few years ago. You know, these things don't play well theatrically because nobody cares enough to go buy a ticket to go watch them because they suck.
You're telling me now for the first time.
But those families and kids, those same people that refuse to go see it in the theater, might just sit home on a Friday night or a Saturday morning with the family and watch them on Netflix. Everybody else has figured this out except Disney. Take a look at this chart here from Nielsen, just from a few months ago, April 2026. And if you look at Roku and Tubi, and you put those kind of things together, some of these companies that are about to merge or get together, you look at Paramount Plus, you look at Disney standing at 5%. That is now an aggregate number that includes Disney, Hulu, and ESPN Premium. When you consider Disney's 5% market share on that chart of the streaming services, and you consider how much they have spent in the last 6 or 7 years on massively expensive proprietary content just to acquire that 5%, and then that also includes Hulu and ESPN with live sports, it's really quite pathetic. It's genuinely pathetic. And when you consider Paramount and Warner Brothers set to merge here in the next few years, or next few months rather, regardless of what a bunch of state attorneys generals are trying to pull off right now, which they will likely be unsuccessful at doing, HBO and Paramount, once combined with their fast services and their premium streaming services, are going to blow Disney out of the water at a fraction of the cost. But back to the article, says Stephen Cahill of Wells Fargo, we don't think the box office, experiences, or brand value would suffer if the library were on a competing global streamer. Investors would benefit from a de-risked business model with Disney focused purely on content versus distribution. Josh D'Amaro may be considering all options. And I find it very interesting for Stephen Cahill to say that about Josh D'Amaro. I hope he is genuinely right. In fact, I hope that Stephen Cahill has had a conversation with Josh D'Amaro, and maybe Josh D'Amaro has hinted at something of this very nature. The reality is Disney Plus in and of itself has been an abysmal failure. And if you remove the content from Disney Plus that Disney itself doesn't even own, then Disney Plus would basically not even be a relevant factor on any kind of Nielsen scale. Bluey, which is made by Ludo out of Australia and licensed to Disney Plus for a relatively substantial sum of money, is basically the only thing that keeps Disney Plus afloat. If they were to lose that licensing contract, Disney Plus would become utterly worthless. The Star Wars and Marvel themes that they spend $200 to $300 million a pop per season on are not driving any kind of viewership there. Places like HBO Max are getting 5 to 10 times the audience, having spent far less money on television shows that go on those streaming platforms. Disney just can't seem to get their act together, which is why we've seen a lot of scale back in many of these shows in the last 12 to 18 months. And I think that's going to continue under Josh D'Amaro. He knows this is not buttering any bread at the Walt Disney Company. And I think Stephen Cahill, even though he's coming around a little bit late, I wish more Wall Street analysts would wake up to it and come around to my side of the aisle that we've been talking about for years, because Stephen Cahill is right. Disney Plus needs to go the way of the dodo, so that investors can actually start making money again. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.